If you haven't heard of it yet, there's a magic number that can make or break your business, and that would be the break-even point. In this video, we'll be diving deep into the concept of the break-even point and how you can use it to take your business to the next level. We'll be discussing what the break-even point is, how to calculate it, and most importantly, how it can be a game changer for small business owners and entrepreneurs. So, whether you're just starting out or looking to take your business to the next level, listen up and let's get started. First, let's define what the break-even point is. It's the point at which a company's revenue equals its costs. In other words, it's the point at which the business is not making a profit, but it's not losing money either. The break-even point formula is relatively simple. It's the total fixed costs divided by the difference between the price of the product or service and the variable cost per unit. Let's take a closer look at each part of this formula. Fixed costs are expenses that a business incurs regardless of the level of production or sales. Examples include rent, salaries, and insurance. Variable costs, on the other hand, are costs that vary depending on the level of production or sales. Those can include raw materials and shipping. To calculate the break-even point, we first need to determine the total fixed costs. Then we need to determine the price of the product or service and the variable cost per unit. Once we have these figures, we can calculate the break-even point by dividing the total fixed costs by the difference between the price of the product or service and the variable cost per unit. It's important to note that the break-even point is not a measure of profitability, but rather a measure of the minimum level of sales required to cover costs. Once this point is reached, any additional sales will result in a profit. Now let's take a look at an example. Let's say a small business owner is selling a product for $10 per unit, and the variable cost per unit is $5. The total fixed cost for the business are $1,000. Using the formula, we can calculate the break-even point by dividing the total fixed costs by the difference between the price of the product and the variable cost per unit. In this case, it would be $1,000 divided by 10 minus $5, which equals $1,000 divided by $5, or 200 units. This means the business needs to sell 200 units to break even. Understanding the break-even point is essential for small business owners and entrepreneurs because it can help them to make informed decisions about pricing, production, and sales. Knowing how many units need to be sold to break even, a business owner can adjust the price of the product or service, or the variable cost per unit, to reach the break-even point more quickly. Let us know in the comments down below what you think about this magic number and how you'll use it in your business. Don't forget to like this video and subscribe to the channel for more content. And we will see you soon.